Warm greetings to everyone. Hope all are doing well. I am Dr. Jisha, Associate Professor and Head Department of Professional Management Studies, Kristu Jayanti College. Today we are going to discuss about income from capital gain. So income from capital gain is the fourth head of income of an individual. So before moving to detail about income from capital gain, let us see what is capital asset. So capital asset means it is a property of any kind held by an assessee, whether connected or not connected with his business or profession. So it includes movable, immovable, tangible, intangible, fixed, floating, all kind of this are considered as capital asset. What is capital gain? So capital gain, there should be a capital asset. It must be transferred by an assessee. The transfer should take place in the previous year, and the gain on such transfer should not exempt from tax under section 54, 54B, 54D, 54EC, 54ED, F, GA and GB. So when an individual does not come under any of this exemption, they will be taxable under the head called as income from capital gain. So what are the conditions when an assessee will be considered under income from capital gain? The first one, any gain arising out of transfer of capital asset in the previous year is called as capital gain. The capital asset is a property of any kind held by an assessee, whether or not connected with his business or profession. It includes all kind of property, whether movable or immovable, tangible or intangible. So we saw it is an asset, capital asset, and there is a transfer. So let us discuss what you mean by transfer. So transfer means it is an exchange, any sale, relinquishment of assets, and compulsory acquisition under law. The meaning of relinquishment of asset means it is ceased. Any transaction which is being taken under any of these scenarios, it is considered as transfer. Next, what are the items not considered as transfer? If there is an amalgamation happens, or any transfer of debenture or bonds into shares, any transfer of assets in time of liquidation, any transfer of asset by parent company to own subsidiary company, any transfer happens under gift or will, any transfer of asset at the time of partitions, any transfer of assets being government security made outside India by non-resident to another non-resident. So any of these scenarios cannot be considered as transfer. Basically, there are two categories of transfer. So the assets are classified into short-term capital asset, long-term capital asset. Under short-term capital asset, you have financial asset and non-financial asset. Same way in long-term also, you have financial asset and non-financial asset. So financial assets means it's nothing but securities and stocks. And non-financial assets are like land, building, plant and machinery, jewelry. These all come under the category of non-financial asset. When an asset will be considered as short-term, when an asset will be considered as a long-term. So if an asset is being holded less than 12 months, then that is considered as a short-term, especially the financial assets. And non-financial asset, if an asset is holded less than 36 months, then it is considered as short-term non-financial asset. The same way, when an asset will be considered as long-term financial asset, if an asset is holded more than 12 months, then it is considered as long-term capital asset. Whereas non-financial asset, when it will be considered as long-term means when an asset is holded more than 36 months or 3 years, then it is considered as long-term. Exceptions are there. In case of land, we considered only 24 months. And this is a format of computing long-term capital gain. So first we need to know what is a sale happened in the previous year. If there is any brokerage or any sale deed, you can deduct that. So the balance what you get is net consideration. From that, the two important items you can deduct. One is indexed cost of acquisition. Another one is indexed cost of improvement. The balance what you get is considered as long-term capital gain. So this is an inflation index. For the current inflation index, if you see, for 24-25, it was 348. Let us see what is cost of acquisition. So cost of acquisition means it is a cost incurred for acquiring a property. So any self-generated asset is treated as nil. The cost of acquisition is nil. What do you mean by self-generated asset? It is nothing but like goodwill. So any assessee has not incurred any cost in the previous year or in acquiring the capital asset. The cost incurred by the previous owner will be taken as cost of acquisition. For example, you got a property from your father as a gift. So that property is not purchased by you. So the cost incurred is by your father. So the purchase cost incurred by your father will be considered as cost of acquisition. The next is cost of improvement. It is a cost incurred by an assessee to improve the status of a capital asset, which is nothing but alteration, renovations. So anything which you add on the property, it is called as cost of improvement. And we saw the indexed cost of acquisition. What is indexed cost means? It is nothing but an inflation cost which has been added to the present value of an asset. So this is applicable only for a long-term capital gain. So every long-term capital gain will be using indexation. And the next one is indexed cost of improvement. So indexed cost of improvement means it is a cost incurred, the inflation cost which has been added in the improvement of the asset. So any cost which you incurred before 1/4/2001, any improvement you have done, that cannot be considered for calculation. So any improvement which you have done after 1/4/2000 can be shown for a deduction. So this is the way we compute indexing. Suppose a long-term capital asset is purchased before 1/4/2001 and it is also under gift. So how will you compute the indexing is either the actual cost or fair market value, whichever is higher, you will divide with the base year and then multiply with the current inflation index, which is called as 348. And the cost of improvement, which is incurred on or after 1/4/2001. So the formula what we use is cost of improvement divided by that year index value into the current year index value. The same way, long-term capital asset acquired after 1/4/2001. So in that case, we take actual cost of the asset, divide by the acquisition index into the current transfer index. So same way we apply even for improvement cost, any improvement which has been done after 1/4/2001. So the cost incurred improvement divide by the index on that year into the inflation index of transfer of this year. So this is how we calculate indexing. So I think this video was very useful for you. Thank you.